Hello and good morning, listeners. This is Almus Market Mornings with Shikhar Garg bringing you in all the updates for you to move around in the financial markets. The US inflation data, which was widely awaited, was released yesterday and more or less was in tune with the market expectations, except for the year-on-year figures. Now, such numbers which we are talking about for US inflation, they've just ensured that the shift in belief of market participants comes in sooner than expected about the higher rates for a longer period. Uh, we are also expecting a slew of data releases today and in the week further, like the Indian trade balances as well as the UK inflation data. So, JK, with the kind of data releases and the reactions that we are seeing in the financial markets for such data releases, what are your thoughts? How should we be moving around?
Good morning. Yes, there's a lot of economic data to digest for the markets. And of course, CPI always takes precedence over everything else because inflation has been the theme of the last 1 year. CPI in US yesterday came higher on month-on-month basis, but that was expected. But year-on-year numbers, along with revisions, was much hotter. That raises prospects of more hikes by the Fed and pushing the yields even higher. The big problem remains the services, along with the strong labor market and core services marching to a 40-plus year high. That's the problem for the Fed. Overall services inflation vaulted to 7.6% year on year. And this gives the ammunition to Fed basically to come out with more hawkish rhetoric. Some analysts now already started hinting at possible 3 more hikes by the Fed, taking the terminal rate to 5.5%, but 2 seems to be given. In fact, one of the Fed members, Mr. Logan, said that Fed must be prepared to keep raising rates for longer than anticipated if needed. He also said that even after pausing rate hikes, they may need to be flexible, tighten further if conditions call for it, and need continued gradual rate hikes until we see convincing evidence of inflation falling to 2% and in a sustainable way. And that tightening policy too little is the topmost risk for the Fed. So unlike what the market has been expecting, we have been seeing good numbers from major economies, and inflation remains sticky. CBs have been quite hawkish. Growth accompanied by possible second-round inflation is something not priced in by the markets, which means yields stay higher and relative higher growth prospects of other economies can also keep the dollar slightly on the defensive. Better titled theme for 2023 would possibly be disinflation being transitory. The markets, except for yields, which moved almost one way up, both dollar and stocks were swinging wildly after the data. Equities ended mixed with small gain for Nasdaq, while Dow and S&P closed with a small loss. The 2-year yield was 10 BP higher, and the curve slipped further into inversion with 10-year at up 6 basis points, while the 5-year yields notched up the biggest gain of 23 basis points from the lows of the day before moderating slightly. The sell-off in the bonds was across the rate markets. German 10-year was 7 BP higher, and stronger wages data in UK 10-year gilts up a large 12 basis points rather. Looking through the volatility in the immediate aftermath of US CPI report, most currency movements have been modest. Dollar is flat on the DXY at 103.30. GBP was the top of the G10 leader. Better GDP and employment data supported the euro as well, while the employment report from UK, particularly on the wages front, supported rally in both the currencies, but somewhat moderated after the CPI numbers from the US. More gains for these currencies look difficult right now, not due to economic reasons, but due to kind of positioning in the market. Just to recall, both the euro and the GBP have been rallying relentlessly from the lows of September 2022. While yields are expected to stay higher across, the relative growth prospects of economies will eventually decide the course of the dollar, which now looks to be at a neutral level. Upcoming data risks may be a greater risk for the market, still mispriced to the glaring growth signals coming from all the hard data. We had already jobs data and ISM coming much stronger last week, followed by yesterday's hot CPI. Main focus today will be on the US retail sales numbers, which is expected to have bounced strongly, given that January auto and truck sales numbers have already beaten expectations. Later, we will have the industrial production again and expect to improve substantially compared to last month. UK will also announce their CPI inflation for the month of January today, and generally, pound is having a positive bias because of the yields again starting to go up much more than what the market is been expecting. On the rupee, it's been charting its own path, quite oblivious to the rest of the world of currencies, but generally on the weaker side in view of the continued imbalance between demand and supply. And central bank's actions gets more critical as we near 83 levels. Yesterday's WPI at 4.73%, coming slightly above market consensus, but still, eighth month of continuous fall has neither an implication for the rupee nor the policy move. Central bank and the market will be slightly worried about inflation coming above 6%, in fact 6.52%, which puts the rate hikes certainly one more hike and possibly two more if inflation even remains at this level. So it's the rates market that is on the focus everywhere, and India possibly with a higher nominal yield may not see the rupee weaken too much, because even central bank would be likely intervening more to contain the imported inflation. Looking very closely at the central bank action and the market approach as we approach the 83 levels. Thank you.
Okay, JK, that's quite interesting. And yes, folks, we have a higher nominal rate which can, at some point in time, be attractive enough for the foreign investors to chip in with their flows in the country. But at the same time, as JK mentioned, there have been some concerns with the spiked up inflation that we saw in the previous data point, which has pushed concerns for another round of rate hike by the central bank. And we have also observed the central bank being cautious enough and acting in the markets to make the imported inflation not so a worrisome factor for the Indian economy. But on the other hand, if we have to talk about the US inflation, as we've been hearing, so service inflation, which marched on to the 40-year high, has given furthermore scope for the Fed to continue with the rate hikes, with the expectation now of another 2 to 3 rounds of rate hike, bringing the terminal rates to as high as 5.5%, which were initially being expected to be lower around 5% and probably also heading with the rate cuts by the end of the year. But this now seems to be changing as the expectation for the market participants. Growth, although, is also parallelly visible with strong numbers on the growth indicators. So it needs to be seen how things go about with the disinflation and the growth. And if we have to talk about disinflation, yes, folks, as we were hearing some time back that the inflation was transitory, there is a possibility of a new narrative that the disinflation can be transitory. So it's only time will tell whether disinflation continues to be there or it's just transitory. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.